That's why it's interesting, that question of asking, like, how old did your parents live?
Yeah.
2/3 of a pension goes to, or the life pension goes to a spouse.
Generally.
Afterwards, if there's
And then that's it.
no spouse, it's done.
That's it.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
All right, so this is the first question without notice. We'll start. Is what's life like with 2 kids?
I was going to say it's twice as busy, but I think it feels a bit more than that maybe. I don't know. I just keep thinking, what was I doing with all my time? Like, I thought that when I had one, and then now there was actually a lot of time still. But now when you have 2, they really pinches it down. There's not much left. I don't know what 5 must be like. That doesn't equate.
You just start to ignore them. I think that's the key, is you just ignore them after a while. You give them less attention. You've only got so much time that you can spread around.
I suppose as they get older, they get a bit more self-sufficient.
They're supposed to. Arguably, they're not that self-sufficient. All 5 of them are still at home. How early is too early to tell them to move out?
Well, I was out, 18 and a couple of months and never went back. So I'd say 18. That's when you're an adult.
You better
what do you think?
I was going to say like 16. 16's pretty good.
16. It depends. I would have happily gone.
At
A lot of my mates went to boarding school though, which it's still a little bit like you get looked after.
Were you a chance to go to boarding school?
No chance.
No.
I wasn't getting there on a sports scholarship like most of them, so I just hung back and kept the public school system propped up.
Where did you move? Did you move in with mates, or you went to uni?
Just straight to res at uni. Yeah. So
best time of your life.
Yeah, simple times. You think there's never a worry in the world.
So who's going to get a slab? Who's ordering?
We just trying to work out what was the cheapest for the week.
Tooheys Red?
Yeah, Tooheys Carlton Cold.
Was it Tooheys Red? No.
Tooheys Blue. I don't know. Carlton Cold was pretty cheap.
Tooheys Extra Dry was.
I just rotate around. They all taste good if they were cheap.
Yeah, a big block.
Yeah, the cube.
Yeah, we better talk some finance. So we're going to do our best to stick to 4 topics, keep them short and sharp. First one, you sent me a rambling voice mail this morning. So the question is, with rates falling and markets rising, where should your money go now? So maybe just give some context of what you were thinking this morning in the car at 8 o'clock.
I was thinking lots of things, but I was actually listening to just the daily ComSec update, which I'd listen to most days. It's a nice, probably little plug if anyone just wants a relatively simple overview of what's happened overnight and what's maybe going to happen for the day ahead. And it just triggered me as well, and some recent conversations, and it's pretty topical. Obviously, interest rates is just, I feel like it's all we talk about at times. But it's pretty important, isn't it? And obviously it dictates not just markets, but it probably dictates emotions and things as much as anything. So what we've seen over the recent years was obviously interest rates being a little bit higher than they were, which we had pushed a bit of funding into those fixed interest markets. So your term deposits were a bit more sexy. They were pretty boring. No one had them. There was a lot of people probably barely knew what they were for a period of time. They became a nice place to park some money, get a bit of interest, and feel pretty comfy. Property became maybe a little bit less attractive because you weren't getting that passive income level you were getting, and now there was nothing left over, and you're actually starting to tip cash flow in just to keep it propped up. Equity markets have actually been okay, so shares have been okay. So now you're reaching a point where people are going, what do I do now? Like rates are coming down, so my cash isn't getting me the income I wanted. Rates are still at a point where the property's not giving me much residual income, but also at the same time, share markets and a lot of the stocks, they sort of do look relatively expensive because the market's it's hitting all-time highs. So it's a weird sort of time because none of them feel like a natural place to go. Property probably pulls on the heartstrings a little bit for people, but there's still a lot of things holding that back, isn't there?
Well, people on the cash versus shares. People see that, like you said, that rate of return on their cash decreasing, but also get a bit nervous about loading up too much in the market.
Yeah, your timing, it doesn't feel like you want to run into that market. And again, it's sort of, if you just look at the graph very simply, like I said, it's all-time highs. So that would probably tell us, history would say it's not the best time to be putting a heap of money in there, but at the same time, it's continued to climb pretty consistently. I was looking at some returns yesterday, year to date, sort of 12s, 13s, 14s, and there'd be a lot of times in the last 12 months where people thought everything's about to implode.
Around February, March.
February, March is a good example, but I suppose it's probably going back to a little bit, tying through to some of the principles that we go back to, is you just got to be super consistent with those things all the time and continuing to invest in all conditions, don't you?
Well, two things: you got to continue to invest, but you also got to continue to make sure that you've got some powder dry.
Yeah,
like and this comes down to asset allocation and not getting too emotional either way. Being all out or all in, but constantly investing no matter what's going on and being prepared to pivot. Adjust incrementally depending upon what's happening in the market at any particular time.
I probably sound a little bit pessimistic about if you've got money, it's a tough time to go. I'm not a pessimist, that's you. I'll leave that to you.
I'm the realist, Ben. I sit in the middle.
I'll take your word for it. I think as much as it might sound a bit pessimistic in terms of everything sounds like it's not a good time to buy term deposits, maybe it's not a good time to buy property, or shares are expensive, whatever you want to view it, it's just the perfect time always to have a look at what you've got and what you should be trying to do. And whether that's setting yourself a trigger for investment into property, or, starting off with something small and building up even just your education around markets and cash holdings versus shares. A lot of people have been cash heavy. Historically, people probably were cash heavy with good rates. And then we had that such a long period of, 2% interest rates that, the cash disappeared, it flowed into equity markets, and then it sort of leveled itself out again in recent times. But a lot of people we see, I'm sure you're the same, where they've sold properties in the last few years because they've been sick of costs and regulations and rates, and so then they have a lump sum of cash or they've inherited funds. They're probably the ones this maybe screams to a bit more, as just sitting there staring at it going, what do I do? It was a year ago they just said, I'll put in a term deposit for a year. Now it's come due. They don't really want to roll it over at 3. Do they?
No, and I think you've said a few times on this podcast that one of the biggest risks is indecision and making no decision, like being prepared to actually make a call. And again, you've said it multiple times on here that there's a risk of being out of the market altogether. You don't have to be all in. You can be incremental. We talk strategies of averaging clients' money into the market over time. I think those people with lump sums at the moment, either from inheritance, sale of assets, you got to be thinking about how, like you said, what are your triggers? What sort of program of investment can you use, even though the market is at like all-time highs, to still benefit from being in the market?
And you're not buying the market either. Like there's some stocks that have done incredibly well, but if you run your eye through it, there's some that sort of, they're still screaming value in there as well. So, not every single investment all performs equally. That's the idea of having the diversification. You're not going to perform like the absolute best one, and you shouldn't perform like the worst. We should have a nice spread of those across different sectors. Like even, without getting too detailed, but something like maybe like a BHP, which a lot of people have held forever, like it's gone nowhere in the last probably 5 years. I haven't got the data in front of me, but it's really gone sideways, especially in the last 12 months. So, people may view that as an opportunity. It doesn't mean just because the market's up 10 that it is up 10 as well.
So to answer the question in closing, where should your money go now?
Depends, doesn't it? It always depends. I suppose the key thing is talking about it and creating a plan, and knowing that it will take time, and being patient with that to implement that over a period of time. So structure, take the emotion out. That's always key, isn't it?
Yeah, and as you said, you can think a little bit too broadly and think, I want to be all out of the market. There's nuance in that. There's plenty of opportunities in the market, whether the market more broadly is at all-time highs. Even if interest rates are on the way down, there's opportunities in every asset class. So if you don't know what you're doing, talk to us and we'll put you in the right direction. All right, next topic, Ben.
How long was that?
10 minutes.
That's pretty sharp.
Very sharp. So next topic, so we're talking sort of defined benefits. So the question is, should you take the money now or secure income for life? So just some context around defined benefits. And the reason this is topical because I've had a few clients in the last couple of weeks. Defined benefit superannuation, it's kind of a dying breed, but there's still
probably that last wave of them almost. Maybe I've seen a few in recent times as well. I think those last ones who are probably starting to think about retirement or are exiting the workforce. They're probably the tail end. There is still a few schemes around, but not many.
No, there's not many, but I think they're coming. We're seeing more of them at the moment because they're coming to the end of their end of their life or the beginning of their life, depending on which way you look at it. So the defined benefit, in simple terms, when you have a defined benefit super, you get the option at retirement to take that as a lump sum, in simple terms, and do with it what you will, or take it as a guaranteed life income. There's some nuance in there, but
if only it was that simple. And if you sort of keep it in a simple thing, it's like I think you can win a form of Tats Lotto where they go, we'll give you X amount per day or a lump sum, and people do the maths on it. And it's not always that simple. Like there's obviously many factors, and these different schemes have different pros, cons, tax consequences, beneficiary consequences, don't they? So it's there's also some that offer just a lump sum now as well. So if you see defined benefit, I have seen as well, just as sort of a side note, is that people assume that they're then going to be eligible for an income stream. But there is also now a lot of them that you just have a calculated formula. You retire, they punch it in, and they give you that lump sum. Then I find it really challenging for those clients because they've never been investors before. Often, because their super is not market linked. So when I say that, majority of the population, their super's invested in the market. It goes up and down, and they've had some exposure to the market movements. A defined benefit is just a calculation, generally linking to years of service, average salary, and some other nuances around it. So it's a calculation. It's not a market exposure. And if you go sort of similar to recent topics, you go from having zero market exposure to $1 million market exposure, it's going to make you feel pretty uncomfortable. And you carry a lot of risk because often it defaults into the market.
Yeah. Well, it flows on perfectly from that previous topic. We said you get a lump sum and you've got to make a decision about what to do with it right now. And the couple of clients that I was thinking about over the last couple of weeks, it was, how do you make the decision? What are the things that actually impact your decision about whether or not you do take it? Let's assume you can actually take it as a lump sum or an income stream. In your mind, what are the things that influence whether you would take it as a lump sum and make decisions about how it's invested versus take the guarantee of a life income? And we'll talk about what the guarantee actually is.
Yeah. Well, there's a lot of factors. I think age is definitely one of the first ones I would hit on because if you think about how long will you live now, no one knows the answer. But if you can use a little bit of some statistics to go, right, well, if someone's taking it at 60, they're probably more inclined to live longer than the person taking it at 75. Now, health probably rolls straight into the back of that as well, and not just the individual's health. Maybe probably deep dive it a little bit and talk about their family history. Like what's the family's longevity look like? It might sound a bit weird, but ultimately we're deciding, how many years are you going to receive this income for? So you're trying to work out, okay, how long is the sort of potential break-even point between the lump sum being of more benefit or the income stream? And again, each provider, based upon the point in time it gets triggered, will give you a different option as well, won't they, with that? So and then there's, again, what other factors would you take in before you're sort of even doing the numbers? What questions will you ask the client?
Those first two questions are ones that I asked around health. So, and it's probably important to give some context around why you actually ask that question of health. So, the couple of clients that I can think of recently, if you look at the guaranteed income alone, if you look at the lump sum that you could receive versus the guaranteed income, and you just did the rate of return based upon the income stream that you get from day one, it's actually pretty attractive. Like it might be sort of 8-9% guaranteed rate of return. However, the rules with the guaranteed income are that if you've got a spouse, only 2/3 of it in most instances passes to the spouse. So why do you ask about health? Well, if your health's poor and you're likely to not be around for that long, it's not 8%, it's 2/3 of that that we have to calculate. And also thinking about your partner and whether you do actually have a spouse. So
that's the thing. Also, it's both parties. You're assessing it as a household, like most things. if there's no one, well, then it's a higher risk. They might argue, well, there's no one else. So I don't really care.
So one of the other questions is around what other assets have got. So what risk are they actually happy to take? What level of guarantee do they require? If I had to generalize, I would say the people that don't have much by way of assets and don't have a lot by way of dependents and beneficiaries might be more inclined to take the guarantee of a regular income over their life.
It's funny. There's a big mental hurdle, as much as you can put all the numbers and data in front of them, where the feeling of getting a regular paycheck, for lack of a better term, feels more comforting for them. They don't have to worry about market exposure. They don't have to worry about an 8% return or 6% return or what's happening in the world politics and economics. So that often pulls people towards that. Like there's often a bit of a bias I find from people coming in towards the income stream, and then it's them trying to sort of justify to themselves or consider the alternatives too. There's also hybrid where you can have a bit of both, which often I have found is a good option because it gives you regular income, consistency, stability, but it gives you access to a lump sum, which might be travel, car upgrade, health, anything like that. If you think about it, if you have an income stream for life and you don't have many other assets, you become very budgeted and you have to be regimented saver. Otherwise, you're not funding your trip to Europe because you haven't got a pool of asset to go and slice that out of. So, again, that's where it comes back to their overall situation and other factors around it as well. And
that hybrid model is an interesting one. I had a couple, and again, every defined benefit is very different. Yeah. It's probably worth noting is that there isn't a set rule that applies to all defined benefits. So when we get asked a question around what the rules for lump sum versus life pension are, they can be very different. One that I looked at recently actually had the option to opt out of the life income stream before a period of time. So you could take it as a hybrid, and then the bit that you took as a life income stream, you could opt out of it and take it as a lump sum prior to age 70. So
I've seen a few where they have, and again, there's probably another trigger for people to probably, they might have been on these income streams for an extended period. I have seen examples where the providers are also trying to get rid of them. Because if you think about it from the other perspective, is they're paying you for life, and if you live a long life, they're indexing it generally twice a year. They're on the hook and they've got to keep funding it. Now, so what they're doing for people is they're then coming and saying, oh, well, how about we pay you out? Like we'll give you, have a negotiation on paying it out as well. I have a client, he passed away only a couple of years ago, and I think he was 92, I think, when he passed. So, and he'd opted for a majority or all income stream 30 years ago, and it indexed twice per annum for that whole period of time. It was just a very significant amount of income that it was way above his needs. Now, guaranteed the person who provided that to him would have probably been relatively happy when they didn't have to pay it anymore, although they still have to pay 2/3 now to his wife, who's also pushing 90. So longevity, if you've got it, makes those things quite lucrative. But there's no guarantees on that, is there?
That's why it's interesting, that question of asking, like, how old did your parents live?
Yeah.
Why would I ask that? Well, for that exact reason. Important to note, I don't think we said it, that 2/3 of a pension goes to, or that life pension goes to a spouse.
Generally.
Afterwards, if there's...
And then that's it.
No spouse is done.
That's it. So that's the other side of it too. People will do the calcs in many different ways. If you think about, let's say you get offered, and this is literally what it would be like as a bit of an example. They'll say you can have $1 million, or you can have $60,000 per year indexed for the rest of your days. And then they do make it because they are very much an even sort of calculation from a return point of view. But you got to get a lot of 60 grand a year to get your $1 million.
Correct.
And that's often where it comes back to. Not saying that that's always the case, because they do vary, but there's certainly not a one size fits all. And I think I would certainly never want anyone to think that we tilt towards lump sums for any reason other than where we see the numbers are compelling to do so.
So the answer of should you take your money now or have a life income stream? Depends.
It depends.
All right, mate. Topic number 3. We're going to talk. We talked investment bonds this week at a couple of our meetings. So the question is, why are investment bonds making a comeback in sort of modern advice strategies?
I suppose the first thing is,
what are
they?
Yep.
And they get termed investment bonds, sometimes called education bonds, insurance, like they sort of get misnamed sometimes also. What if I said to you, what do you view an investment bond is? And I suppose, again, you've been around a bit longer than I. You might have seen the first sort of iteration of them. What do you say when someone asks you about them as an explanation point?
When you think about an education bond, it's a conservative investment that historically an education bond was a conservative investment that was set and forget for a period of time for a set purpose, for your kids' secondary education, tertiary education, something.
Is that essentially like a coupon payment at the end of the term?
Yeah.
So it wasn't essentially a market linked investment strategy.
No, it wasn't. It generally was similar to a cash investment, a fixed interest investment. I didn't particularly like them, like the education bonds as they were previously. I always tended to say a market linked managed fund investment averaged in over time, in my mind, outweighed like an education or an education bond. But there's been an evolution of what bonds are, what they do, the tax strategies, the tax rules that apply to them. And I think that's why they're making a resurgence. So back to what an investment bond is. What is it?
Well, investment bond is essentially another tax structure or investment structure that we can make use of. So if you think about it, you've got the ability to invest in your own name as an individual or joint name with maybe partner or some other party. Superannuation is probably the other tax structure we talk about the most, which obviously has concessions on income and capital gains tax. You can use family trusts and companies, but it's a little bit different because an investment bond sometimes might be owned by one of those parties, and it has its own unique set of rules that are applied to it. Now, like anything, a bit like super, I always think about it that there's got to be a bit of like a reward for effort on it. So what they're saying is, okay, we'll let you invest in this concessional tax environment, but you got a decade, and then you can start to reap the rewards of pulling funds back out tax-free. So in simple terms, pays 30% tax on earnings inside the bond. Again, some of the bond guys might be jumping up and down because there's some nuance to that. But as a flat line, you assume 30% tax on earnings inside that environment. At the end of the 10-year period, it can continue on being invested, but everything you can then pull back out of it is tax-free income coming back to you. So you think, oh, why would I want to do that? It's probably tilted towards your high earners more. It also works well for kids where you've got really young children and you've got an extended time frame until you expect to need funds out of it. Like if you've got like newborns or young kids, then you might pivot towards this as a strategy. And it might not be in full, but it might be in part for you trying to future-proof their education funding, their first car, first home. I've said for people for medical expenses or anything. Like you don't know what's going to come on later on in their life. So again, that's my sort of short take on it. What would you add to that?
No, I think that's, as an alternative to other tax structures, yeah, the investment bond has some advantages, but it also has some restrictions. So maybe let's talk about,
definitely,
because I think you'd mentioned there, it's more of a trade-off. Like on this hand, we'll give you some concessions, but there's some trade-offs. There's some tax implications of things like early withdrawals or potentially limited access to investment options.
That's historically probably one of the biggest drawbacks, I think, from perception from the outside, was limitation of investment opportunities in terms of what you could invest in, which to the bond market, to the credit of the investment bond makers, is there's much broader access now. So they've been able to expand that out. Now, it's never going to be equal to being an individual investor. Like, that's just not a reality of how they're structured, but there's a broad range there. So in terms of what you can invest in, there's still mostly direct equities, managed funds, index funds, some ETFs, that sort of style of investment. So you can be diversified with it and you can average money into it. From an access point of view now, historically, if you didn't meet the 10 years, there was some harsh penalties and things around access, or maybe even an inability to access with some products. Now you could access in an emergency, you can pull it out, you pay your square off tax, you're not penalised, you're just squaring off what you would have paid otherwise, and off you go with your funds. So limitations otherwise in terms of adding funds in. So again, we won't go into too much detail around how this works, but essentially if you add money in the first year, in the second year following, you can add up to 120% of that. But you have to remember that's a trailing thing. So if you add 10 grand in year one, 12 grand in year two, and 0 in year 3, that's it. There's no adding in year 4. You're done. So you have to be consistent, which again is one of the reasons why a lot of the questions, and when we're sort of fact finding and goal setting, is it actually appropriate? Like, are we going to be able to maintain our contributions through the period? Because if we miss a year or we drop down, then we dip. Whereas something maybe like an individually owned investment account, you might go 10 grand year 1, 10 grand year 2. You had another child year 3, you drop it down to 5 grand, and then you level out after that. You've got more flexibility in terms of adding in and drawing out from it, but potentially you pay a bit more tax as well.
So you've got to have a reasonable sense of cash flow, the ability to be able to sustain that over time. And you can set up, you could set up multiple bonds. So
yeah, that's been a strategy for some clients. We've set a couple up and we've said, look, we're just adding in a lump sum, we're going to let it roll. Maybe in 2-3 years we might start another one. That's okay. We just start another one, but that's got an end of 2-3 year lag on it from its maturity as well. Again, it's very much an instrument to be used for some, not for all. I think that's the key. Is this is not something that we're just every client that rolls in off the street needs. I think there's a lot of people who aren't using them. I think there's heaps of people that could benefit from investment bonds now that there's a bit more flexibility and wider range of investment. It also sort of ties in a lot to the rules around superannuation, where tax concessions on super have been watered down a little bit, still the most favourable by far, but with some pressures around that, especially on the high balances, it's also makes them a bit more attractive. The only just from a strategy point where I have begun using them, we've got those clients who are really ambitious around retirement. So they're saying, all right, I want to retire at, let's say they want to retire at 50. Super access is at 60. Let's say they're 40 now. So what we've been doing is, right, they're 40, they're aiming to retire in a decade. We're going pretty hard at the investment bond for the next decade. So when they hit 50, they've got hopefully a quite significant pool of tax-free income they can draw down that sees them through or supplements their reduced earning capacity from 50 to 60 before super comes online. So again, there's a few other ways you can do it, but the investment bonds can be quite favourable at doing that as well.
Cool. So this is easy to answer. So back to the question, why are investment bonds making a comeback?
Flexibility, tax rulings in terms of there's probably been an uplift in benefits from the tax inside the bonds, and there's also been a harshening of tax rules for all other alternatives. So you've sort of got two tailwinds in their favour. If you look at the inflows on these guys, it's pretty scary because people are understanding that the benefit is there again now.
Yeah. And it's most suitable for who?
Well, I would say it
give me your two favourite
clients. It depends because a lot of people are also using them in estate planning now as well. So that's probably where we haven't unlocked it fully yet, and it hasn't been something we've used a lot, but a lot of the education is around estate planning and protecting people's interests as well from a tax planning point of view as well. So I do have a couple of clients with them from an estate planning perspective too. So where grandparents have left investment bonds to grandchildren or children, it really depends. I personally, at this point in time, have been seeing them a lot more for those sort of young family accumulators, but also where they've got high household income because you're trying to mitigate tax. Tax is a big factor when you're looking at these things.
Good cash flow, high tax.
Yeah, that's probably the sweet spot for them, really. And it's just an extra, it's not going everything into it. It's just adding something small and adding it on as an extra little string to our bow.
Cool. All right. Well, fourth topic, last topic. I think we can segue from the last one into this one to some degree. Let me find a thread there.
So how are you going to connect these? I
was going to say retiring early. So this idea of accessing or retiring early, I've got a couple of examples. But the question is, can your age difference? Well, let me start again. Historically, maybe it's frowned upon, or maybe it's seen.
How much age gap are we talking about? That's probably the thing.
So this is talking about where there's an age gap between a couple, and the question is, can your age difference unlock? Let me start again. Can your age difference unlock hidden financial advantages? Let me give you a couple of examples that I had recently. So clients, one, say close to 50, with a spouse 13 years younger, and they have a mortgage, and their question, the debate is, they've got good surplus cash flow. Where do I direct that surplus cash flow? Do I pay it off my mortgage? Do I put it into super? have good income, the ability to do either or. And so I suppose I'll ask you the question in terms of, you look at that client, what are the opportunities where there is an age gap? So you've got someone who's closer to preservation age 60, one that's significantly younger than that. What are the types of things you'd at least be thinking about?
Well, I think access, whenever we think about super, you go, okay, there's the trade-off discussion about using super, you get the better tax environment, but you're giving up time until you can access it. So if you've got one of the parties who's much closer to access than the other, then the benefit and access risk is diminished. So if you're starting to get closer to that now, without deep diving too much, you've got the ability to obviously move funds between spouses, super balances as well. So maybe you got the younger spouse doing some salary sacrifice, moving it across to the older member's account balance, and you're sort of bringing forward potential access of those funds by 13 years, I think you said. So we start to get a little bit deep in the reads of the strategy side of things. But again, it's all about access, isn't it? You go tax uplift. I think if you ran the numbers, and people would find this confronting, is that you're probably better to not pay anything off your mortgage ever and just max your super to the eyeballs, really, because it's always going to stack up better, because that's a pure data thing, isn't it?
It is, and we've done those numbers. I will say that when you're 10 years away from preservation age, you're hard pressed not at least to have the conversation about, am I better to put money into super to my cap, and rather than paying principal off in a perfect world, you do both. Like if cash flow allows you to, you say, I contribute to my cap, I make the most tax effective use of that. I then, any other surplus, if I still have it, I pay off my principal. You might even be looking at some other strategies there about creating some equity, maybe for investment borrowing outside. But I think the point there is that and some of these conversations I've had with clients recently, that it is the opportunity, at least spouse splitting, right? Spouse splitting between couples where there's a significant difference in age is a reasonable strategy to consider to bring forward potentially by 10, 15, 25 years contributions for a younger spouse to an older spouse. And why is that potentially advantageous? Well, like you said, accessibility at preservation age at 60. What do we know at 60 with super? If you're retired and you're 60, money you take out of super, it's income tax-free, capital gains tax-free, allows you to do things like pay your mortgage off at that point. So that was the age gap on the way. So sort of looking at a younger spouse to an older spouse. Let's talk a little bit about clients who are maybe have reached pension age, but have got significant assets such that they wouldn't be eligible for an age pension. And same scenario, you've got a spouse who's 10 to 13 years younger. What are you thinking about there?
As soon as we ever start talking about this strategy, I think it's the most likely one where clients ask the question, is that legal? And the reason they ask that is because it seems sometimes a little bit too good to be true in terms of how you can stagger your assets and ownership to maximize potential social security benefits like an age pension. So
can I give you? So I've got we've got a house. We've got $1.5 million in super for someone who's just reached pension age, and the spouse is 10 years younger.
Perfect. So you look at the situation and go, okay, on the surface, they got 1.5 million of what we would call accessible asset. Your house doesn't count. No age pension for you. But then you sort of peel it back a bit. And any money in the younger spouse's super until they either turn it to a pension after age 60 or till they reach age pension age at 67 isn't an accessible asset. So hypothetically, let's say that they actually had an even split of $750 in super each. Now, they're not going to get a full pension, the older member of the couple, but they're going to get a part pension, and probably what most of them are trying to pick up is more so the card benefits and discounts and things that go with it as well. Again, it depends. There's always a cost-benefit analysis of having funds in super and accessible, especially where the age gap's significant. If you've got like a 3 or 4 or 5 year age gap, well, anything up to 7 really, is you can move money to the younger spouse and still access it. So if they're 60, you could move it to their super. It doesn't count for Centrelink, but you could still withdraw it for a holiday. So that's where it starts to feel a little bit where people start to question the validity of it. But that is the rule. So again, we often start to stagger assets and the distribution of super wealth when we know that age pension or other benefits are likely. It also overlays, sorry, just jumping aside a bit, is people on like a disability payment or carer payments and things, like all of those things. Any of the money you held in accumulation super under age pension age doesn't count against you. So the age gap it's a really big one. I think only other point I want to make on age gap, which I think is a challenge and where people need to get ahead of it. If you have a significant age gap, and this is a little bit anecdotal, hopefully you agree with me, is that if you have someone who's 70 and their partner's, 15 years 55. Younger. Oh, okay. 55, yeah. Then the chances that younger spouse will continue to work through till 65 or whatever it is it's unlikely, I think, because their older partner's going to want to travel. They've done their dues in terms of work, and they're going to limit their ability to live and travel, or they're going to have to travel and live separately, which most of them don't want to do. So often I find where there is a significant age gap, it does take some extra planning and maybe sometimes some extra sort of provisioning for wealth, because it's unlikely both those people will work till they're, let's just say they want to retire both at 60s, their potential retirement age. If the younger spouse is 45 and the other one's 60, it's very unlikely that the 45-year-old will continue to work for another 15 years. That's what I see. So then you've got to make sure that they've really paid it forward early in terms of building their wealth up as a collective, because you're taking it potentially maybe a decade of time in the workforce, income, super contributions, wealth creation out of the picture. So it does create challenges, not that it can't be overcome, but I think it's something that needs to be factored in. And I do find that what they think might happen versus what happens is they end up finishing up work a lot quicker.
I think some of the best ways to address that in conversations with clients is to sort of, I was going to say role play, but play that out. Play that out, and just hypothetically, what would you want to do? What does this actually look like? So you're 10 years older, because I think we have a warped perception of what we're going to be like in 10, 15 years. But if you ask them, like if Ben's not working, what's the age difference between Chloe and yourself?
Chloe's 20 days older than me.
Okay.
So she's older than me, though. Example. That's the main point, is that she is older. But if you have, and you see it all the time, I had a client a couple of weeks ago and they were very aware of it. Like, it was really good because I didn't even have to raise it. He said to me, they had only, I think, it was 8 or 10 years difference. But they knew that was a really crucial period. And that any age gap of that can be a little bit challenging. He's hitting sort of 65. He's had enough. She's, late 50s. She's thinking, I'll probably work till I'm 65 as well. But by the time she reaches 65, he's going to be into his 70s, and he's consciously aware that his health risks, mobility, desire to travel will be greatly diminished by the time she's fully retired. So there has to be a compromise in terms of, and they're very open about it, and they're talking about it, and it's whether she changes jobs or they, it's not that she just won't work, but we do see where it creates challenges, and I'm also always, from a planning perspective, quite conscious of how much more wealth will these people continue to accumulate once the first person does cease work, because there's a risk of income on the second one dropping off sooner than you think.
Yeah, which brings us back to that idea of having the conversation and thinking, particularly if you've got the higher income earning spouse as the younger spouse, and that's where all the superannuation and retirement benefit is. You've got the older spouse who doesn't have a lot in super. That conversation around, should we be splitting some of those assets over early? Remember that you can't retrospectively go and spouse split 10 years worth of contributions from the previous 10 years.
You've got to do 1 year prior.
Yes.
And that's what when we're attaching to clients from an advising point of view, we're doing it most of the time, probably in their 40s, 30s, 40s. I think now is more of a traditional age people come online with advice, is by the time they get to 60, like, we're good. Like, we're not trying to manufacture anything. We've been spouse splitting them for the last 20 years. Like, we've got it where we want it comfortably. It's a challenge when they're coming in and there's only a couple of years worth. Yeah, you can still get benefit and we can still do things, but again, it's like all things, it's just time. If we've got time, we can mold it to what we need it to be. And then the age gap becomes less of a prevalence. I think talking about their wealth as a just as a collective rather than who owns what or whose super fund has what. It's less important when we've had time and tenure to actually assist them with that.
Yeah, so when's the best time to get advice, Ben?
Well, it's a bit cliche now.
Yeah, yesterday. 10 years ago, then yesterday.
It's never too late. I also hate to labour the point that it's never too late, because it's like, I know you'd be the same. I've never had a client come in where there's not something that you can do to enhance their situation.
I think that's the bit that I don't think a lot of people understand when they think, like, I've not really got anything that you can help me with. Just have a conversation with us, because it's not until we actually ask a couple of questions, they're inevitably going to be elements of your situation that you've just blind to. Either going to be some things that you are in full view for yourself and whether it be, you've got your cash flow under control, but your estate planning or the age gap that you've got between you and your spouse, you just haven't given any thought to. And that had been the conversation with a lot of clients recently that I can think of, where they just had a massive blind spot of something that they just didn't know. They didn't know an opportunity was available for them. We have, a half-hour conversation, unearth that, and all of a sudden there's an opportunity to add significant value, not only now, but for their retirement. So in closing, Ben,
age gaps are good.
The age gap's good. So age difference can unlock plenty of financial strategies and advantages.
Like anything, it can open up challenges, which usually has strategies and lots more opportunities that follow it, if you view it the right way.
Yeah. And so in closing, we make sure, I think there's a disclaimer after this, but nothing we've said today is advice. You should come and talk to us. Everything's got nuance. There's a trade-off with just about everything, but give us a call, shoot us an email, and we're happy to have a chat. Anything in closing, Ben? Anything else?
No, it's been good. Nice and broad. Again, it's nice. I like talking about some of the things we're seeing, and we see this stuff all the time. We probably don't talk about it enough, so I'm sure there's people out there that it resonates with.
Cool. Thanks, Ben. We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.